Well, thank you, everyone. Appreciate your time this afternoon. And what's a sunny afternoon in London when people could be having better and possibly more exciting things to do. But thank you very much for joining us today to discuss Latin America. As was pointed out, we want questions. We've already got 3 questions, which is a good start. Please send all your questions in, and we will answer every single question that we are able to do so legally. That people should be aware of. It's something we've done previously on with ShareSoc. When we've done presentations, we try and answer all the questions, not run away from anyone, not just hide behind the presentation. So Ed is going to give a great presentation about an asset class that we're really passionate and excited about today. It's an asset class that, as was pointed out, has been overlooked, but has actually done fairly well this year. While there have been challenges elsewhere in emerging markets, challenges in developed markets, the case for Latin America has come through strongly, and people are increasingly appreciative of what it has to offer. So I'm going to hand over to Ed, and he's going to make a brief presentation. And once he's finished that, probably after around 15 minutes, we're going to kick off with the exciting part, sorry, Ed, which is the Q&A. So Ed, over to you in a hopefully equally sunny New York.
Okay, great. Thanks everyone for their time and interest. As Sam mentioned, my name's Ed Kuzma, and I am the co-portfolio manager of the BlackRock Latin America Investment Trust. And today we're going to go over some of the macro and micro issues that have been driving the returns for Latin America. Year to date, Latin American equities have had a strong start with the MSCI Latin America Index up 12%, well ahead of the EM equities index, which is down 14%, and developed markets like the S&P 500 down 11% and NASDAQ down 19%. And the leadership here has been driven a lot by Brazil, with MSCI Brazil up 17%, Chile up 15%, and Peru up 9%. And if we go to the next slide, we'll outline 5 reasons why we believe investors should consider owning Latin America right now. Next slide, please. I'm just waiting for this slide to turn to the next slide. There we are. And we see 5 reasons why investors should be considering owning Latin America right now. One, with rising commodity prices, this has really underpinned a major improvement in the earnings momentum for Latin American equities. A great portion of our benchmark, of our index, if you add materials and energy, it makes up over 1/3 of the index, and we think the region is uniquely exposed, to a rising commodity environment, which helps the earnings momentum in Latin America. The second reason we like Latin America right now are discounted valuations. Currently, the market's trading at 9.3 times 12-month forward price to earnings ratio. This is more than a 25% discount to their long-term history. Third, we believe that Latin America's central banks are ahead of the curve. Inflation's been an issue globally and in Latin America as well. However, the central banks of Latin America, who have dealt with high inflation consistently in the past, have been aggressive in front-loading the monetary tightening and have provided key support to the currencies. And we think that this tightening will benefit the markets, and it has already helped to the currencies appreciate and provide some stability from an FX standpoint. Fourth, geopolitical diversification. Latin American equities, we believe, given their trading partners, they don't have a lot of exposure to what's going on in Eastern Europe and the geopolitical risk with Russia. And actually, they help to fill a gap in a lot of these supply chain issues that we're seeing, given that a lot of commodities are sourced and exported out of the region, which is also leading to other positive impacts regarding improvements in the terms of trade, increased investment in the region from a CapEx standpoint. And we think these are drivers that could be long lasting. And then finally, we believe that the Latin American equity asset class has seen a consistent decline in its weighting in MSCI emerging markets. And currently, the region only accounts for less than 10% of the benchmark. I started investing in Latin America back in 2004. At that time, the weight within emerging markets for Latin America was closer to 25%. And I think this deterioration over time is just kind of a good display of, Latin America has been underowned. It's definitely undervalued. And we think it's, not currently reflected or appreciated as much as it should be in the context of a diversified global portfolio. And we'll go into some of these issues in depth in the next slides. Next slide, please. Just to highlight, the weightings of energy and materials across emerging markets, you can see that after Russia, Latin America indexes highly in terms of the exposure to commodities. And since the start of 2020, there's been a 60% correlation, a high correlation between the earnings momentum of Latin American equities and commodity prices. Next slide, please. When we look at the valuations, throughout time, very rarely throughout my career have the valuations been cheaper than they are today. You can see from this chart that the forward PE for the MSCI LATAM index is trading at 9 times forward earnings. This is a deep discount to its historical average around 12.7 times. And we think a lot of this valuation that we've seen here is further perpetuated by the strong earnings momentum led by the increased prices on commodities, and it makes a cheap market look even cheaper. Next slide, please. And just wanted to highlight how we believe our third point here, that the LATAM central banks are ahead of the curve. If you look at the spread between the policy rates in various countries over the US monetary rate, you can see that the dark line here, Brazil, has been very aggressive in front loading their hikes. And we believe that, further hawkishness, while the central banks are cautious and everyone's treading lightly with the inflation projections, we think a lot of the heavy lifting's already been done in Brazil, and other markets like Mexico and Chile and Peru have also done a decent job of, increasing the interest rates ahead of developed markets. And this has led to a strong appreciation of the currencies, as we see a re-entrance of this so-called carry trade, where developed market investors will borrow at low rates in their local currencies, invest in foreign currencies, and that's definitely been a key driver of FX year to date in Latin America. And then we'll just go to the next slide as well. And finally, when we talk about Latin America, you can see from this chart since the turn of the century, the weighting in emerging Asia has been increasing, and a lot of this has been driven by high growth tech type companies in Asia, whereas we've seen a continuous downdraft in terms of the weightings in Latin America. And I think, taking a step back, when we look at some of the factor rotation that's been a dominant theme in the markets, we've seen a lot of rotation out of expensive, highly speculative growth stocks in Asia, and that money has been coming into relatively cheaper valuations with more of a cyclical, component to it. I would say the free cash flow yields and the dividend yields in our region are attractive and higher than I've seen throughout the majority of my career. And I think that in lies the opportunity here. I would say Latin American equities are undervalued, underowned, and I believe that the performance is for a catch up and a persistent outperformance of Latin America is overdue. So with that, I will just kind of pause and maybe hand it back over to Sam. We would love for a very interactive conversation here in terms of Q&A, and Sam's going to kick that off.
Yeah, great. Thank you very much for that presentation, Ed. Yeah, we're deliberately leaving it here early to allow lots of questions. We have 4 that we can see. That's not very many, unfortunately. But we're first going to go to our host, who I think has some questions to ask of his own. So over to you, Paul.
I've always got questions to ask. And I guess one of the first ones is, I listen to quite a lot of podcasts, and particularly from American investors, and a theme that often seems to come across from America is how concentrated American investors are on American companies. It seems that there is very little appetite at all for casting their net wider. I mean, they might be something that they are forced to do a little bit with as the market corrects. But I mean, is that your experience? As you say, it's possibly part of why it's so underowned in the global portfolio. America seems to have sucked out so much liquidity from everywhere.
Yeah, I think it's a fair question, and I think it's definitely a function of history. And that basically, for the majority of investors and the majority of their lifetime of investing, you could have done nothing better than own American assets. American assets over the last 5, 10, 20 years have had higher returns and less volatility than almost every every other asset class. And therefore, you kind of back test this. As a foreigner, you may say, okay, I want to have a global portfolio, but if you're sitting in America, why on earth should I risk investing elsewhere when all I need to do is own a NASDAQ ETF and it's gives me a higher return than anything else? And the answer to that point is, over time, diversification is critical. Global diversification is critical. And the last 10, 15 years have been fairly exceptional, a period of time with very low interest rates globally, a period of time where certain investments have gone up regardless of earnings, a period of time where it's sort of you've been paid to invest in companies that have no profits and actually are prodigious rages of capital and give you no dividends. That's not the history of investing over the last 100 years, but it's definitely been the history of the last 15 years, and it's encouraged a certain behavior, which I think you're seeing in the podcast you're listening to. And sort of the home country bias exists for all of us, but it's been particularly prominent for US investors, and one can kind of understand why.
And I've got another question, which is about a specific stock. I looked at your top 10 holdings, and I wasn't surprised, but I was interested that Mercado Libre doesn't appear on it, whereas it's one that's almost a poster boy for a certain type of stock. And it is obviously a South American stock, which, it must be a conscious decision to not have it as one of your biggest holdings. And again, does that speak to your focus on valuation and free cash flow and metrics such as those?
Look, we're not going to comment on individual stocks, but let me make the general point as follows. And the general point is that when we're looking to invest in any company, we're looking to see what our edge is relative to the market. Just saying a company is a good company is not actually a great reason to invest, because lots of other people will know it's a great company. And the question is to be, what is our edge in assessing? Is it an even better company than other people think it is? That would be point number one. Point number two, as you said, is valuation is important, especially in emerging markets. There are lots of people out there saying, valuation isn't important. I think the track record of emerging markets shows that it's always important, just not necessarily on a 1-year view, but on a 5-year view, it's been repeatedly important. And unlike in the developed world, there are very few companies that can just make their own weather. The reality of the complex macroeconomic, political, and currency moves means that the number of companies that can just grow on their own year after year and outpace GDP growth is far fewer in emerging markets than it is in the developed world. And the data really backs it up, that if you actually look at the MSCI index and you sort of look over a 10-year period, the number of emerging market stocks, you start with, let's say, 500 companies that you've got data for a decade, and you see how many of those companies are actually able to beat GDP growth in terms of revenues or definitely profits or cash flow year after year, the answer is negligible. Extremely few, like literally 1 out of 500, unlike in the US where it's a much higher percentage. And so that's just the reality of investing in emerging markets. The countries change, the realities of the societies they invest in change, the politicians change, the rules change. That's emerging markets. So my general point would be, it's sometimes dangerous to invest in what seems to be a surefire winner in emerging markets, because often they're overpriced and then suddenly stuff happens. And stuff is a very broad term. incorporating lots of mess that happens in emerging markets. And sort of the reverse of that is when people get extremely depressed about various countries or asset classes or sectors, sometimes it's a really great opportunity. So I'm not going to directly refer to an individual company. We're not allowed to. But what I will make is those sort of general comments. Obviously, we're aware of the investment opportunities that exist in Latin America. We're aware that there's some great companies out there, but great companies aren't always the greatest investments. So hopefully that's touched on your two questions. Any others from you? We have 7 others. I'm going to ask you. We're going to ask you one other from a gentleman here. Will we be able to see a recording of this later? That's beyond my fund management skill sets.
Yes, is the answer to that one. That we do, as long as you're a member of ShareSoc. So that's the simple answer. If you're a member of ShareSoc, then you can catch up on the repeats. And so become a member is the simple answer. But before I hand you over to the Q&As, I just like one more question myself, which is that obviously BlackRock are, and I don't know whether you're the world's biggest, you're certainly one of the world's biggest investment managers. What sort of team are you able to tap into in terms of getting research on the region and give you an edge?
That's really important, and I guess it always comes down to, so getting an edge always comes down to 2 things. Accessing different sources of information from fixed income, from customer suppliers, competitors of the companies we invest in, and processing that information. For us, it's really important that we have a big team. We've got a 40-strong emerging market equity team spread all the way from New York through London to Asia. And one might wonder, what's the value of having people in Asia? Well, obviously, China, despite its problems today, is a very big producer of goods globally, a consumer of commodities globally, is integrally critical to the global economy. And so understanding what's going on there, having people on the ground is really important. So we have 40 people on our emerging markets team. We also have a very well-resourced fixed income team. We are also supplemented by our real assets team, who sort of invest in real estate and in infrastructure across Latin America. And that's before we get into the people that support us in running our portfolios to ensure that our portfolios are deliberate, diversified, and scaled, like our risk and quantitative team. So there's a lot of resource beyond just the Ed and myself in terms of managing the portfolio. There are a lot of analysts, a lot of expertise across a range of different disciplines across the globe, helping us put this portfolio together. It doesn't mean we don't get things wrong. Of course, we get lots of things wrong, but it helps ensure that we've got a better chance of getting things right.
And I suppose, sorry, it just leads on to when you're talking about all those asset classes. Is there any type of industry that you wouldn't invest in, or are you would go anywhere within Latin America fund?
So we could theoretically go anywhere. The exceptions would be number 1, places that are sanctioned. We can't, obviously, and sanction would be if it's sanctioned by the US or sanctioned by the UK or sanctioned by the EU. So there are quite a lot of bodies that we have to sort of think about. That's not very relevant for Latin America. Of course, it is very relevant for developments further east. It's relevant for when it comes to investing in Chinese stocks. It's relevant for us when it comes to investing in Russian stocks. Generally, it's not very relevant for investing in Latin America. It does have an impact on a couple of companies, for example, that have hotels in Cuba or have assets in Venezuela. For example, we don't have any exposure to those, but neither could we have exposure to those. But beyond that, within the equity realm, we can invest anywhere in Latin America, from the tip of Patagonia to the Darien Gap and beyond, into Central America and into Mexico. We can invest anywhere, but it's critical that it's deliberate, diversified, and scaled. So hopefully that helps. And now we have some questions to address. Please, Paul, feel free to add in more when we've addressed these. The first one that we're going to say here, which is the top of my list, is going to go to Ed, since he's been quiet now for quite a few minutes. It's not fair. First question is, what are your thoughts with regard to the new government in Chile and new legislation on mining companies? Over to you, Ed.
Okay, great question, and one we ponder quite often. I would say, we have a new political regime in Chile that took office in early March. I would say the honeymoon is definitely over. The disapproval ratings for President Boric has gone up, and there's a lot of fear in the markets before the election. I would say that typically when there's a lot of fear in the markets, you have a big sell-off, and sell-off to me equates to cheap valuations and opportunity. So we're always cautious when we hear some radical reforms on the campaign trail, because usually the case is a lot's promised during a campaign, but when the candidate actually takes office, it's a lot tougher to get stuff done. There's a very strong opposition in Congress that I think will keep checks and balances on any radical reform. At the same time, Chile is going through a constitutional reform. Some would say long overdue, and this will go a long way, hopefully, to appease the social discontent and the rising income disparity within the country. They're also being pretty proactive in addressing a lot of the ESG issues that have come about. Water, as the question in the queue states, and the rights to water is a main issue. I would say that how are the companies dealing with this? The mining companies we invest in, we talk to, they're coming up with creative ways to recycle water. They're investing in desalination plants, taking seawater, removing the salt and able to use that. Heavy use of recycling of wastewater within the operations is also a part of the situation. We heard the word nationalization in certain industries thrown around a lot on the campaign trail, and I do see legally how this is tough to go through. A lot of these companies, they have concessions to the various mineral bases that they look to extract that are long lasting and backed by a solid legal framework. And I do believe that the rule of law is strong and remains strong in Chile. So I think nationalization is more of a word that provides a lot of fear, but in actuality, it's tough to see how that could be implemented. So we're cautious overall, but I would say that some of this excessive rhetoric is just that excessive, and quite often can provide an opportunity for investors with a long-term time frame like us.
Cool. Yeah, and I would just sort of add, which goes on to the next question. You'll see where I'm going with this in a second. How are you viewing political risk in the region? Is that a factor in the low ratings of the stock market? And I think this is a very relevant question for not just Latin America, for all emerging markets. There's a fundamental difference between the developed world and the emerging world, and that in Latin America, and that is political risk. When we think about political risk, obviously we've just had French elections and there was a risk, the wrong candidate could have won. But generally, when it comes to elections in the Western world, political risk is far more muted. The two political parties, or the two major political parties, depending which country you look at, have a broad understanding of how the country should be run, and there are certain rules that apply, and whether the left-wing party or the right-wing party win, it doesn't make too much of a difference. The reality of investing in the emerging world is that typically the institutions are less mature and they have less power to curb the excesses of politicians, and also that politicians are able, often through their misdeeds, to cause a lot more harm to the structures of these countries. And one can go through the history of Latin America in the last 70 years and find no shortage of politicians that have managed to enrich themselves while impoverishing their countrymen. And so politics is important, and it's an integral part of what we do. As I said earlier, you can't just find companies that can go their own way. That you really have to have an understanding of politics, macroeconomics, fixed income, and currency when it comes to investing in Latin America. Because when the currencies go down 10%, the markets go down 20%, and you lose 30% extremely quickly, and saying, oh, I've got a great company, is not going to help you, because we focus on returns in dollar terms, not in real terms or peso terms or Argentinian peso terms. For us, what's really important is returns in hard currencies. And so typically what happens is when there is a mess, that's reflected in all the asset classes, and equity is that very small sliver of hope between two big numbers called assets and liabilities. and that small sliver of hope can get wiped out extremely quickly. So politics matters. And it does make sense in general that emerging markets and Latin America should trade at discounts to the developed world. The question is the quantum of those discounts, and the discounts that we sit at today are pretty high by historical standards, as Ed was saying. So politics is important. And the further point was just to add about politics, which is that when people sort of say, talk about politics, people often get onto the topic of sort of ESG and say, from an ESG perspective, how can one possibly invest in country X or in stock Y or in sector Z? And it's important to remember that we believe that these countries we invest in are not Switzerland, they're not Sweden, and people shouldn't expect the countries of Latin America to be Switzerland or Sweden. The key thing for us is the direction of travel, and we believe that through interaction, through conversation, through dialogue, we can improve corporate behaviors, we can improve the behaviors of politicians. And just walking away rarely helps discussions. One doesn't really improve other people's behaviors by telling them they're very naughty or they're doing it wrong. It's through education and it's through interaction, which is important. So we are aware of the political challenges. We're aware of the somewhat related ESG challenges in our markets. We don't hide away from them, and we spend a lot of time discussing them with relevant stakeholders across this beautifully diverse continent. But we believe the general direction of travel is positive, and we believe that investors should not be walking away from the world. They should be interacting and educating the world, and that's one of the jobs that we have to do on a regular basis. The next question, next question I'm seeing is the financial situation in Argentina. Is it a cause of concern? How are you viewing this within your risk profile? Back to you, Ed.
Yeah, great question. I mean, Argentina, the macro situation there, it's a little more complex than other places in Latin America. We don't have a particularly favorable top-down view of the macro there. I would say the main issue is hyperinflation, and a lot of that's driven by some unorthodox policies by a left-wing government. A lot of the companies and countries we talk to, when they talk about their own political situation, they point to Argentina saying, we don't want to end up like Argentina. We don't want that situation. So, no matter how radical our presidential candidates are, they have a good example in their backyard of how not to act. And, the main thing, the Argentina, they defaulted on loans with the International Monetary Fund, and there's been ongoing negotiations on how to, rectify that situation. We think it's going to remain an overhang. We do have eyes towards the next presidential election, where we could see a regime change, and to me that would be a catalyst for market-friendly reforms if they decide to go that route. But just given the situation, inflation, I think earlier this week, it printed at a 60% year-over-year increase, which is obviously a tough situation to deal through. And for that reason, we're not invested in Argentina. We have plenty of options to invest in, say, Brazil or Mexico that have a little bit sounder economic policies. And from a top-down standpoint, we tend to favor those markets. So don't have much exposure to Argentina in the current portfolio, but we do spend time looking for opportunities.
Yeah, and we're not ruling out the next time we do one of these calls having exposure to Argentina. Going back to Paul's point, we're not ruling out Argentina despite the challenges. At the right price, some of these assets could look very interesting. Not everything is completely negative about that country, and it's a country we look forward to having more exposure to in the future, if only the political and macro backdrop was just a little bit better. It's interesting to think 60% inflation, and this takes us on to the next question. 60% inflation sounds a lot, but it's only about 2 times what PPI is running in Germany, believe it or not, today. I mean, who would have thought that we'd have 30% inflation in parts of Western Europe? And this is the next question. I'm going to skip one question. I'm going to come back to it in a second. But with inflation rising in the Western world, my guess is that we'll have a higher and knock-on effect in Latin America. How is this possibility affecting your investment decisions? And what do you think the outcomes may be in Latin America of these worldwide changes? Ed, I always love your comments on inflation especially the professionalism of dealing with it. Over to you, and then I'm going to add a few comments.
Okay, great. Yeah, and I think this question it highlights you know, a major characteristic of the LATAM inflation basket. And you know, when you think of Latin America, obviously there's a wide income disparity here. The average consumption basket of your average Latin American consumer, it's heavily weighted towards energy and food, and those are the two areas of inflation that are extremely important right now, as they've been, you know, increasing probably more so than other parts of the inflation basket. So for us, you know, one way that we manage the portfolio and to position correctly, you know, given the current realities, you know, we're generally underweight consumer discretionary. We realize that, you know, given the higher inflation, the consumer has less disposable income to spend out at restaurants or in the shopping malls. So, you know, we're more cautious in terms of discretionary type names and investments. And contrary to that, where we overweight. So the rising inflation, you know, it's, as I pointed out, it's been combated by higher interest rates, which looks to suppress demand and kind of control inflation, and takes out kind of excess liquidity in the markets. And who benefits from this? Well, it's mostly the banks. Higher interest rates allow the banks to reset their loans at higher rates. They're not lending as much as they have in the past, but you know, that's with an eye on keeping the asset quality under control. But I think that you know, the current positioning of, say, overweight financials, underweight consumer discretionary, you know, we're playing the beneficiaries here of higher inflation, and that's generally the banks who have higher net interest margins or stronger net interest income growth on the back of higher lending rates. So that's kind of how we look at managing our way through a difficult inflation situation.
And my sort of additional point on this would be, you know, as kind of Ed indicates, Latin America has got a first degree, a second degree, a PhD, a professorate, a professorship in dealing with inflation. Sometimes the countries have done well, sometimes the countries have done badly. But what is unprecedented at the moment is the level of inflation in Western Europe and in the US. And we're in a quite ridiculous situation where, you know, the vast majority of people working today have never experienced inflation at the levels which it currently is in the US and in the UK. We have to go back to the late 70s to see the levels of inflation in Western Europe, in the US and UK that we have today. So you'd have to be pretty much close to 70 to have been working at that period of time or investing at that period of time, which is not the majority of the working population. You contrast that with inflation levels in Latin America, which are high. But you know, Brazil's inflation is high, but not unprecedented in Ed's memory. Inflation in Mexico is actually not particularly high and definitely not unprecedented in Ed's memory. Ditto what we're seeing in Chile, Colombia, Peru. It's not a great situation, but it's a fairly regular situation as opposed to what we're having in Western Europe, which, as you know, has been pointed out, is unprecedented, or at least in 30 or 40 years. And it's really quite strange in a sense that the politicians in the West and the central bankers in the West are, you know, having these great discussions. Should we raise interest rates by 50 basis points or 25 basis points? As if, you know, raising interest rates from 0 or near 0 to 1% is really going to have a great impact on inflation, which is in many cases 7, 10, 12, 15%. It's kind of a bit of, you know, running such negative real rates is a really interesting question, whether that's a great strategy on a sustained basis. I leave it to the central bankers who thought that inflation was transitory until transitory became transitory. And that was just sort of 6 months ago. So I think Latin America is not in a good situation, but it's in a better situation than what we're seeing elsewhere in the world today. I'm now going to refer to one question here, which is actually going to go to a gentleman on our investment trust team called Charlie. Could you please elaborate on the proposed tender offer for up to 24.99% of the company's issued share capital? Hopefully, Charlie, you can hear the question. Oh, there you are. Brilliant.
Yeah, can you see me now?
And over to you for that one.
Hopefully you can hear me. So good evening, everyone. Charlie Kilner here. I Also based in London, covers sales and investor relations for BlackRock's range of investment trusts. So yes, this particular question on the tender offer, as part of the board's discount control policy, or the trust discount control policy, the board have offered to make a tender to shareholders for up to 24.99% of the issued share capital. And that is subject to either of two conditions being met over the 4-year measurement period, which lasted from 1st of January 2018 up until the end of last year, the 31st of December 2021. Those two measurements were either were to satisfy an outperformance of the index by 100 basis points per annum, and so it needed to achieve that. If it failed that, that would trigger the tender, or if the discount was at a greater than 12% over the period, an average discount of greater than 12% over the period. If that was wider, then that would also trigger the tender. The tender was triggered because the performance measurement wasn't met. And so on the 4th of January this year, the board announced that they would be putting together information about the proposed tender offer, which they have now issued in the form of the circular, which has been sent out to shareholders and is also available on the website. So I'll try and add the link into the Q&A function for you to be able to click through if that's of interest. But essentially the tender is, well, the information is live at the moment. The tender closes on the 17th of May, ahead of the AGM, which is on the 19th of May. And I should say the tender is also subject to the continuation resolution passing at the AGM on the 19th of May, and also the tender offer resolution that's been put together by the board over the last few months, that also being passed at the AGM. If those two are passed, then the calculation date for those shares that you have tendered will be on the 20th of May. That gets announced on the 23rd, and then settlement date is on the 24th of May. But please do, if there's a 52-page circular on this, which I recommend you read and have a look at if you're considering the tender. And if you have any sort of further questions about that, please do get in touch or speak to a financial advisor. But I'll try and put in the link to that circular into the Q&A function now. Hopefully that answers any questions or queries you had. I should say that the board will also be offering another tender or proposing another tender offer over a similar 4-year period from the 1st of January 2022 through to the 31st of December 2025, so another 4-year measurement period, which has started thus far, subject to that being approved at the AGM.
Thank you, Charlie, an expert on all 52 pages and much more. Do you just want to comment, since you've got the mic, and it's a question we often get, just about the dividend policy of the trust?
Sure. So the dividend policy on this trust is it has an enhanced dividend. So the board, I think it was in 2019, proposed proposed to shareholders to adopt this enhanced dividend policy, whereby a quarterly distribution is made equivalent to 1.25% of the US dollar NAV at the end of each quarter. So a nominal yield or distribution of 5% if the NAV remained equal. And that has been in place now partly as an incentive to attract retail investors, really, because we know that income is particularly cherished and sought after these days. But it also means that because some of that income is topped up and paid out of by capital, Ed and Sam are not encumbered by searching for yield, searching for income from the stocks that they're investing in. They're seeking a maximum total return, and the structure of the investment trust vehicle then enables us to pay out that 1.25% per quarter at a sort of circa 5% yield.
Thank you, Charlie. Please keep sending your questions in. We haven't had any new questions for some period of time. So please, if anyone's got any questions on Latin America, please send them in. I think we've kind of addressed the next question I can see here, but just giving Ed the opportunity. How do you see the current situation in Chile in relation to water shortages and nationalism and nationalization? We kind of dealt with that earlier, but Ed, anything you'd like to add on reflection on that question, or anything that I missed out on the questions on inflation or just the prior questions?
Yeah, I think Chile, historically Chile has been one of the more stable economies in terms of, say, fiscal deficits or current account deficits. And while we do see the new government and some of the social needs for higher government spending as probably a good thing in terms of dealing with the social unrest that's been going on in the country a couple of years back, it will be a sign of probably higher taxation, trying to extract more benefits from the private sector, whether it's, investment and soft social benefits, say hospitals and education and healthcare. But I think, coming out of COVID, a lot of governments spent a lot of money trying to bridge the gap between pre-COVID and where we are today. A lot of that had to do with higher fiscal spending. And a lot of the countries, not only in Latin America, but globally, are going to look to increase taxes to help fund what was spent during the pandemic. So I would say Chile, all in all, I don't see it as too much different of a situation than other countries in Latin America or other countries globally.
Cool. Next question. How do you research and investigate LATAM companies as prospective investments? Do you have sources of information in each Latin American country? Do you speak Spanish and Portuguese? So let me start off by saying I don't speak either Spanish or Portuguese, and I barely speak English, as will have been obvious to people who have been listening for the first 46 minutes of this call. Thankfully, the vast majority of people we interact with do speak English, and I believe every single stock exchange in the region requires that companies put out their disclosures in English as well as Spanish or Portuguese, which definitely helps us. And the IR departments who we speak to, but they're not our major source of information, typically almost always speak English. For us, it's really important to speak not just to the companies, but to speak, as I indicated earlier, to their customers, their suppliers, their competitors, who are typically a little more honest about the first company than the companies are themselves, to speak to all stakeholders who are involved in their value chain, because that helps us understand really what the company is about. Is the company doing well? Is the company doing badly? Don't just speak to management. Management may have a slightly more positive view on their own successes than is really the case. And especially, as I said earlier, in countries where politics matters, where regulation matters, sometimes one can miss the wood for the trees if one doesn't get some of the bigger picture angle. We do, of course, have people on our team that speak Spanish and Portuguese, but alas, I am not one of them. I would also stress it's really important for us to travel across the region, and all members of our emerging market platform, obviously not all of them are here in the room, but our global fund managers also travel to Latin America frequently. I've had the privilege, pleasure, and occasionally disappointment of having been to each of the countries of Argentina, Brazil, Mexico, Chile, Peru, to look at investments and to try and find interesting investments and sometimes less interesting investments. And it's really, really important to spend time on the ground. And one of the great things of COVID now, thankfully, perhaps not quite behind us, but broadly behind us, we can go back to these countries. My last investment trip just prior to COVID in December 2019 was a wonderful trip to Chile, where I spent time with a union leader and his placards outside some of the protests. That's what one has to do, spend time with a student protest leader as well. It was all about protests at that time. It's really important to spend time not just with the obvious people, but also with the less obvious people in a country to understand what's really going on the ground in these places. For people that want to see me at a protest in Chile, well, you won't be able to see the picture on here anyway, but it makes for good viewing. Ed, back to you. Anything you'd like to say about how we research companies?
Yeah, I just agree with Sam's statements. I'm a big believer in the mosaic approach, which is, getting inputs from all different directions to formulate your own view on a company. We look to have high conviction ideas. We have a concentrated portfolio with under 40 stocks. Currently, in previous years, it's been over 60 60 companies within the trust. So I believe that our ability to, go over multiple pieces of information to form a view and generate conviction is what separates us as active managers as opposed to, say, just buying an ETF. I would say that like the access to data and the access to information is never an issue. There's always, if you look hard enough, there's always a piece of research or income statements. It's really, for us, the challenge is processing the data and the information, because a lot of companies, they might have a good, investment story that they're presenting to clients, but when you kind of look under the hood, you get more questions than answers, and that kind of brings up red flags. And management might be focusing on this bright, shiny object that looks pretty on a PowerPoint presentation, but when you actually, dig into it, it's not really meaningful for cash flows or income statements, or might even be a detractor for cash flows. So for us, the research part, it's not really having access to management or having access to the data. It's being able to process that, and I think that differentiates us from say, like I said before, of say a passive approach through an ETF.
Is there a certain size of company at which below you won't invest in? Ed?
So, one of the key risk metrics that we follow is liquidity. It's very easy to get your money into an investment, but if stuff goes wrong, or say the political environment turns a different direction than what you anticipated, we need to make sure that we're able to get out of a investment if, say, our thesis is proved wrong. So for us, the main determinant here is the average daily trading volume. We say companies that trade more than $5 million a day are investable, but to be honest, above $10 million a day is preferred, just because these tend to be the names that you can get in. Sam has a good quote with Hotel California. If he wants to share that, I think it's appropriate. It highlights the issue here. But for us, it's liquidity. It's being able to get out just as easily as we can get into an investment.
Yeah, it's the idea of being able to check out, that you can never leave. That's true in countries with capital controls. It's also what happens when you build too big a position in a small cap name. We do have exposure to small and mid cap names, but it has to be appropriately scaled, because obviously the risks of not being, you have a wonderful thesis, but a terrible investment is desperately unpleasant. Your views on the forthcoming presidential election in Brazil and potential effect on the market. So I'm going to start off by saying politicians are rarely wonderful people these days. It seems that's not just true in the UK. It's not just true in Brazil. It's probably not. It's probably a global phenomenon. We'd have to sort of have a beer to discuss why that is the case. What we might be faced with in many countries around the world is the choice between two fairly unpalatable or seemingly unlikable characters. And I think Brazil sometimes gets tarred with this approach that, it keeps having a series of bad leaders. I think that's a fairly global issue. What Brazil has, though, is a very vibrant democracy. And I think vibrant democratic countries are really flavor of the month globally today. I think we've seen what happens in places that are less vibrant in their democratic characteristics. So we will have an election that may lead to a transition in power. And like other transitions in power, there will be swings and roundabouts that come with that. Certain groups, sectors are going to win. Others are going to do badly. And I think, one will find very big differences of opinions in the corporate world in Brazil as to whether the last few years have been a disaster for Brazil, have been acceptable for Brazil, or have actually been rather good for Brazil. One finds very strong differences of views, and I would just be mindful of the fact that our impressions of the success or lack of success of a Brazilian government, or indeed a Mexican government, should not necessarily be shaped by The Guardian and the BBC. Spending time on the ground is probably more helpful, and spending time with the locals is probably a more important gauge of whether the country's governments are doing a good job and bad job. And that's nothing to do with Mr. Bolsonaro or Mr. Lula or AMLO or anybody else. To spend more time on the ground and speaking to people gives one probably a better assessment than a 1.5 minute piece on Channel 4 News. Ed, anything you'd like to say about the upcoming elections in Brazil?
Yeah, I would just say relative to other elections we've seen recently, say in Chile or Peru, we have two known entities in Brazil. We have the incumbent, President Bolsonaro going against former President Lula. So we have a very good idea of each candidate's policies, how they reacted in certain situations. And actually, as I talk to different CEOs from Brazil, they paint Lula as not such a negative light as you might imagine. There's very positive things in terms of reducing the income gap in Brazil under Lula's first term. You've seen a rise in wages and an expansion in the middle class. And Lula's negotiation style, he executed a lot. He was able to get a lot of stuff done, given that he's able to talk and then negotiate with different parties. He's very highly regarded in political circles, and even some of the Brazilian voters, they recognize that there was an issue with corruption during Lula's tenure, amongst his governors and members of his party. But some people are willing to look past that and say, at least he delivered. At least I had more money in my pocket. So you really have to look at what's going to be the key issue in this upcoming election, and it appears to be the economy. Are jobs being created? Is there foreign investment coming in? Is inflation? Is there expectations that'll come down? I think those are the main issues, and each candidate has their own way of dealing with the economy, and we'll see how the outcome is, later this year. But we don't expect the same degree of uncertainty, given we know the candidates and their backgrounds relative to other elections we've had in the region recently.
I think we only have 4 minutes left, and we're being asked if we're going to go through any more slides. I'm going to try and tackle the last two questions and possibly a follow-up question from Paul, and also go through all the slides in 4 minutes. Any particular hangover from the pandemic in LATAM? Probably a hangover for some of the carnival activities in Rio. But I think the issue is, LATAM was very much hit badly by the pandemic across the region. Really interesting to understand why a place like Peru did so badly compared to some other places. Obviously, lots of deaths on an absolute number across the region. And I think eventually vaccines were rolled out, and good vaccines were rolled out across the region fairly effectively, but it definitely took time, and a lot of life was sadly lost. But that was unfortunately true in many parts of the world. And I think what we're seeing now is the snapback in spending and revenge spending in a post-pandemic world. And we're seeing that in sort of cyclical sectors, in airlines, in lots of areas where people are able to travel for the first time and enjoy themselves in a few years. Anything else you'd like to say about the pandemic, Ed?
No, I think Latin America was one of the regions that was the last to receive vaccinations. I would say that the distribution network for vaccines is pretty strong in Latin America, given that they've dealt with other viral incidents in the past that needed vaccination. So once they're able to acquire the vaccinations, the rollout's been pretty quick, and adherence. It's less political in Latin America to get vaccinated or wear a mask, which I think is a plus from a health standpoint.
Any limits on how much you can invest in Brazil and Mexico? Currently 70% plus, and please can you share your current weightings in the various in the fund? So I was reading the question and it was removed from in front of me, which made it really difficult to read it. But I think that's what it said. So Ed, possibly just being ahead of the curve, as the current slide says, could you possibly show current weighting, since you are able to control the slides better than I can?
If we go to slide 17 in the presentation, you'll see that healthcare, as I mentioned before, it's one of our largest active overweights within the fund. Financials is one of the largest active overweights. There we are. Healthcare, I think healthcare is a great place to invest in Latin America because we've seen throughout the pandemic that there's a need for high quality private healthcare. The public healthcare system is not the best, and a lot of people, there's a high demand. Once you have a formal job, to get formal health insurance and go to a good quality doctor, there's definitely demand for that. Some of our underweights, we were talking about the benefits of commodities. We see materials and energy as some of our largest underweights. While we see the region as a benefit of the high commodity prices, we're a little bit cautious. We think that there's been a strong run in the raw material prices, driven by a lot of geopolitical uncertainty. We think over time, a lot of the supply will catch up with demand, and we do have some questions on the demand side with China going through a bout of COVID right now and severe lockdowns. Generally, we think that the growth outlook for China, maybe the policy targets of 5.5% growth this year might be too optimistic. So on the demand side, we're a little bit more cautious on some of these commodities following a strong run up in prices where we've been taking profit.
So I just want to end off, we've hit the hour mark, and we didn't get a chance to get back to Paul. It's really interesting. Almost all the questions were focusing on the negative side of things, and that's sensible. Investors should be thinking about the risks and not just the returns. Hopefully, in the last hour, we've highlighted both the risk and return opportunities within Latin America. We're really excited about the outlook. There are challenges, and we've discussed a number of them. We can't hide away from them. There are always challenges in Latin America, but the outlook, as Ed highlighted right at the beginning, 5 really strong reasons to be thinking about Latin America, 5 reasons why we're bullish and think investors should relook at the area that has been ignored by so many for so long. And we thank everyone for being with us today on the call. We'd love to handle more questions and very happy to take them, but I think our hour is up, so I hand back to Paul.
Well, before you go, let me just, because you'll be able to deal with these two very, very quickly. One is a number of investment trusts these days are spreading their wings and taking positions in private companies, taking private equity positions. Is that something that you would want to do, have any interest in doing, can do?
I would start with, number one, that would be a decision for the board to make, not for us to make on the fly in a public call. But at a very broad level, we think there's plenty of risk already in the public markets. And the reason why people have gone into the private markets in the US is because the public markets are so ridiculously expensive. So they've had to go and, dump liquidity to try and get sensible valuations. The advantage of investing in Latin America, as Ed highlighted earlier, is that the stuff is beautifully cheap already. We don't have to go and become illiquid to get cheap assets.
And there's just one other tiny question, which is that when one thinks of South America in terms of the size of its industries, you often think of it being a great powerhouse in the world of agriculture. Is that a sector that it's easy to find investment opportunities in, or is that buried under consumer staples in your portfolio? Or is it something that there's just not really the opportunity to invest in size?
I'll start. There's absolutely opportunity to invest in agriculture across the whole range of agriculture, whether that's sort of in farming, whether it's in production of crops, whether it's in sort of the broader soft commodity space, whether it's sort of a bit further down the food chain, pardon the pun, and lots of interesting opportunities. Always have to be mindful, though, about the ESG impacts of some of these investments. And so we do have exposure, but it's something one just has to be really, really aware of. There are some downsides to industrialization of food manufacture that are all too present in Latin America. Ed, final word?
Yeah, I think there's a lot of opportunities in soft commodities. We have some investments, say, in Brazilian livestock. That we see, positive demand and beneficial cost dynamics going on in the market right now. There's always opportunities to add more in soft commodities, given valuations at any given point.
Well, that's extremely helpful. So I think you've answered all of my questions. You've answered all of our attendees' questions, and it's been a very informative and hopefully entertaining hour. It's certainly entertaining for me. So thank you very much, Sam and Ed, and also be aware, everyone, that Charlie put a couple of answers to questions at the chat box at the bottom there. So do go and look at the information he's provided there.